Now, our next guest has been one of the most accurate analysts on the stock. Her calls on Baidu have raked in close to 300% returns for our clients. We have RBS's Wendy Huang joining us on the program today. Wendy, nice seeing you on this Tuesday. So Baidu still a buy at this point. The last time you were here, you said if Google does pull out of the mainland, this could be a 25% upside surprise for Baidu. Is that how it's going to play out?
I think at that time, people are really focusing on the Google News impact on Baidu. But now, since we are already in February, and Baidu will announce its results very soon, so I think it's time to focus back on Baidu's own operation, especially how is the Phoenix Next migration going on these days. So our forecast for Q4 results for Baidu, we expect its revenue to only decline sequentially single digits in Q4, and Q1's migration is still on track based on our channel check recently. So we think internally the migration is going on smoothly, so this should be positive for Baidu.
Okay, what's the probability of Google actually pulling out of the mainland?
I think it's right now it's not really the time to talk about probability, because it's kind of not company's own decision or the government decision anymore. So I think it's better to focus on how Baidu will strengthen their own competence during current period, and how are they going to get more advertisers' attention, get more user traffic, and also to prove to the market that their Phoenix Next is a better ad bidding system than other systems in the market right now.
So you're reeling back your expectations then, because about a week and a half ago we said, you know, what happens if Google does pull out? You said if they do, 25% upside for Baidu. Probably you're saying that that's not going to happen anymore, right?
I think it's things become tricky now. We will not say they're likely or unlikely, because it's Google's decision, not really Baidu's decision to do so. Okay, well, hopefully we'll see how it plays out then, and maybe you can make changes accordingly. Let's talk about your other buy calls. You have it on Tencent, Ctrip, Alibaba. But again, when people look at these tech names and look at it on a PE or PB basis, I mean, they're astronomical numbers, 60 times earnings, even forward earnings. But you're saying a better barometer is to look at the earnings growth ratio, the price to earnings growth ratio. That seems to come in the single digits, and these companies are still worth buying into, right? Yeah, if you look at the whole sector is still growing very fast, especially looking into 2010. Some cyclical internet subsector like online travel and online ads will see a year of recovery, and also 2010 is also a year full of events for online ads or online travel. You will have the Shanghai Expo, you will have the World Cup to boost the advertising demand, and also to boost the travel demand in China. So I think for some stocks like Ctrip and Sina, they should benefit from this macro changes in 2010 continually. And also these companies, they have been expanding market share by close to 5% over the last cycle.
Okay, so let me ask you, when people say what is the best buy in the Chinese tech space, internet space, what would you say to them, since you cover most of these names?
Our topic for 2010 currently is Alibaba and Tencent. The reason that we are positive on Alibaba, partly because it's in the best internet sector right now. E-commerce sector, we think, should see the strongest growth out of all the internet subsectors over the next 3 years. And also, you are likely to see most of the IPOs coming out of this sector instead of online gaming sector. So the IPO tide should be able to lift the valuation of the e-commerce sector, and should be able to indirectly benefit the currently listed company like Alibaba.
Yeah, what about Tencent? You know, I hear a lot of strategists and analysts come on and they keep talking about Tencent, but this is a stock that's tripled in the past year. So if they buy in at these lofty levels, some would say, what are your gains for this year?
Right. If you look at Tencent share price, it does triple in the past 1 year, but actually its forward multiple didn't expand that much. It's always trading at quite a stable range between 25 to 35 times forward PE. So what triggered the share price increase is really nothing but earnings growth. So what has been driven the earnings growth over the past year is actually online gaming. Online gaming itself has grown more than 150% over the past 1 year. And I think going going forward, apart from the online gaming, Tencent should be able to cross-sell more internet services and products on their more than 1 billion registered user platform.
Okay, so if investors buy into Tencent and Alibaba now, how much can they gain this year?
Based on the current share price and our target price implied more than 30% upside for Alibaba, and also around 15 to 20% upside for Tencent.
Oh, wow. Pretty impressive numbers. Wendy, we're running out of time, but you said you have a positive outlook on the dot-coms, the internet portals in China, but you have a sell, I believe, on NetEase and a hold on Sohu.com. So what's wrong with these two internet portals that you're not so enthused by?
Actually, for NetEase, its share price has dropped below our target price recently, and we still like this company's R&D capability, but we're just more concerned about the recent regulatory issues impact on this company itself, especially World of Warcraft approval still not gained from the GAPP. So it's more about financial impact on the NetEase 2010 earnings due to this regulation noises.
Okay, Wendy, nice to see you. Wendy Huang of RBS.